Well, let's go ahead and get started. Good morning, everybody, and welcome to our first client update of 2021. Um, Brandon is going to provide an update on our firm, Steward Partners.
Good morning. Hope everybody's doing well. Thanks for calling in. Just a brief update on our firm. Steward Partners Global Advisory is an employee-owned full-service independent partnership catering to family, institutional, and multi-generational wealth. At the end of 2020, Steward had locations in 13 states and Washington, D.C. In September of 2020, Steward also announced the acquisition of the wealth management business operated through Umpqua Investments Incorporated. The acquisition is expected to close in the first quarter of 2021 and marks Steward Partners' expansion into the Pacific Northwest. With locations across New England, the Mid-Atlantic, and Southern United States, Steward Partners' acquisition of Umpqua's wealth management business now gives it a national reach. In other highlights, Steward Partners is one of the fastest growing independent wealth advisory firms in the country and ranks 10th amongst all US-based advisory firms in asset growth. Recent accolades include being ranked number 24 on Barron's 2020 list of top 100 RIA firms. In 2020, Steward Partners was included in the annual Inc. 5000 for the third year in a row, ranking 1127 in Inc. magazine's prestigious list of the nation's fastest growing private companies. The list presents a unique overview of independent businesses to watch in a variety of industries, which are often considered the most dynamic segment of the American economy.
Great, thanks, Brandon. And here in Albany, our lives have all been affected by the pandemic in the last year. At Haase Family Advisors, with Brandon and me and Jackie, a focus this year is going to be on an initiative we're calling a year of financial fitness. If we have to be at home, or at least running our lives on different schedules right now, we might as well use this time to put our financial homes in order. So we're going to begin sharing topics each month to help on that path. For January, our question for you is a simple one. Do you know where your money is? Can you list all your assets on a single piece of paper? In addition to the account statement you receive from us, are there orphaned accounts out there, such as a 401k from an old job, physical stock certificates sitting in a safe deposit box, or accounts that you've forgotten about? We'll be sending an email to follow up with some specific steps to take in the coming days to ferret out anything that needs to be on your single piece of paper. And now we'd like to introduce our speaker for today. Nick Lacy is our first return speaker, and he presented to us on our inaugural client call a couple of years ago. Nick Lacy is the Chief Portfolio Strategist for Asset Management Services at Raymond James Financial, and he helps oversee a team of research analysts who, among other activities, are responsible for setting the asset allocation policy for AMS discretionary, Freedom portfolios, and the Raymond James strategic recommended models, as well as the UMA platform. He also runs the retirement assets for Raymond James. So many of you are asking about what to expect for 2021, and Nick is here to provide some thoughts in the coming year. Thank you so much for being here this morning, Nick.
No, absolutely. I appreciate you having me back. It's an honor being asked once. It's extremely honorable being asked twice. So apparently I didn't scare anybody off the last time I spoke. What I'll do is give you just a quick highlight of some things from last year that I think were important, but also some focal points on next year that we can talk about. And I can go through all these different slides to talk about these things, and I'll probably bring up a couple just to show a couple of data points that I think. But more importantly, what I'd like to do is answer questions. I think at the end of the day, I want people to be able to leave with an understanding of what we think, what we know, and what we speculate, and those are all things that are pretty important. So let me do this. Let me share my screen here, and I think I can do this right. I'm getting pretty good at this. I may have just jinxed myself, by the way.
Hey, Nick, you're pretty good at it, but our participants are audio today, but they have received that presentation.
Well, then I'll stop sharing my screen because they can just listen to what I'm going to say then. All right, so 2020. Here are a couple of things. From the pandemic forward until probably October, there were some very specific actions that were being taken both by central banks and by the governments around the world to kind of provide a bottom support for the markets. And specifically what the Federal Reserve did was they provided liquidity facilities, and liquidity facilities basically says, let's make sure that businesses are able to transact business. And that's kind of the first experiment they did in the global financial crisis back in '08, where credit went away, cash went away, and the Fed basically had to step in and make sure that the cash markets were operating, because that's kind of what drives everything. Uh, this time around, they did that and more, because they also went through and not only lowered rates, they also went back to their bond buying process, but they also started supporting the municipal bond market, which they had never done before, the credit markets, which is the corporate bond market, and just the act of them stepping in and saying they're going to help provide liquidity where needed, the markets were able to stabilize. And we started to see improvements later in April and early into May. And the question, Stephanie, that I get asked all the time is, are the markets disconnected from the economy? And I hear this question, and I understand why people say that, but the answer is absolutely not. So I'm going to give you the three things that I think are important to watch from an economic perspective, because there are hundreds of things to watch. I'll give you the three that I think are the most important going forward. And then I'll give you what the markets are watching, and be able to give you some things to look for. First of all, the markets don't care about where the economy is. They care about where the economy is going. And it's all about the delta, or the change. And they're looking at from one month to the next. Are things getting better, or are things getting worse? And that's what we as market participants have to pay attention to. Are things getting better, or are they getting worse? And in order to focus on that, you want data points. And the first, and probably the key one to focus on, is the unemployment rate. The unemployment rate, whether it is a good statistic or a bad statistic, whether you agree with how they measure it or you don't agree, the markets look at the change month over month. Now, at the peak of the pandemic, the unemployment rate was near 15%. Now, the quote unquote real unemployment rate was substantially higher than that, but the markets don't care. The markets care, did the unemployment rate improve the next month? And the answer is yes. Starting in May, the unemployment rate started to improve, and it improved every month until this last month. December, it did not. December was flat. So the market's basically looking and saying, okay, every month you're putting more and more people back to work. And we went from near 15% to where we are now at 6.7. That trajectory is what the markets were focused on, and that's good. Now, the markets aren't looking at 6.7% unemployment and saying, hey, that's a good number. They're just simply saying it's better than it was. So that's the thing to focus on. Now, the markets are trying to anticipate the unemployment rate change. So they look at every Thursday morning, you get the initial jobless claims that come out, and that's people filing for unemployment insurance for the first time. And in a normal time period, and by the way, I don't know what normal is anymore, so I'm going to use air quotes. In a normal time period, it's between 200 and 250,000 people per week filing for unemployment. And you might have, say, 1 million people filing for continued unemployment, or maybe 2 million people. At the peak of the pandemic, we were having 6 to 7 million people a week filing for unemployment, which is in magnitudes greater. And you had nearly 30 million people filing for continued unemployment. These were off the chart numbers. They were substantially worse than '08 and '09, and the unemployment level was substantially worse than it's been in my entire lifetime. The idea that it's gotten better is what the markets are looking at. So we went from 6 or 7,000 down to about 1,000. Right now we're about at 900 a week, which is still higher than it needs to be, but it's better. And once again, it's that trajectory. So that's the first data point that I would say watch, is the employment getting better or worse. Now, unfortunately, the low-hanging fruit has already been picked. 2021 is going to be much harder to get that number from 6.7 substantially lower, because the lower unemployment gets, the harder it is to add that next job. Now, when we met with the Fed, we asked them, we said, what do you view as the normal level of unemployment? Because of transition effects, there's all these things that are happening. It used to be 5%. That's what they looked for. 5% unemployment is normal. Now the Fed is saying it's probably closer to 4. And the reason this is important is because it tells you that the Fed is not going to look to pull back on their monetary support just because unemployment gets to 5% or lower. You know, they basically said their liftoff, which is basically the easing of the monetary support, which is actually a tightening, isn't going to happen anytime soon, and we'll go through that. So unemployment. The second is inflation. And inflation is one of those statistics that is hard to get a read on what the markets are looking for, but we know what the markets are trying to avoid. And let me explain. Inflation is a lot like the Goldilocks story, where too low of inflation, not good. Too high of inflation, not good. Inflation in the middle, it's just right. What does that mean, just in the middle? You can speculate and say 1.5 to 2.5%. The Fed would be happy. The Fed would prefer 2 to 2.5% because it allows them to inflate our debt issue we have. But you might get somewhere between 1.5 and 2.5. They basically have changed their language. The Fed did. They used to come out and say we're trying to reach 2%. Now they said we're trying to average 2%. And why did they change that language? Well, they said, look, it might take us years to get above 2%. And when we get above 2%, we're probably going to try to keep it there for a while because we want to average 2%. Why do they want above 2% inflation? Because it makes it easier for us to pay off our debt. That's why. Why is inflation important? Because if inflation gets extremely high, and once again, you have to assume you know what an extremely high is. I'll give you my intake. It's probably, if it's above 3% and it stays there, you're probably going to make the Fed uncomfortable. And the Fed will probably be forced to start withdrawing some of this support sooner than later. The Fed wants the flexibility to do what they want to do without inflation dictating it. And right now, inflation's at around 1.5 to 1.6%. But expectations for inflation have been rising, which of course you've seen with bond yields starting to come up again. My expectation is that inflation will get to a little bit over 2%. I think we have a 2.1 to 2.2% target over the next 5 years. That's where we think it's going to migrate to. Now, we could be wrong on this, but I don't think it's going to be substantially higher than that. And by the way, Stephanie, you probably hear from your clients where they say, with all this money we're printing and all this debt, how can we not have inflation? Well, ask Japan why they can't generate any inflation when they print a lot more money than we have. They're at 220% debt to GDP, and they have negative interest rates and very little inflation. So we can't assume that monetary policy of the 70s is the same as monetary policy today. So I would be cautious on that, but it is something that we have to watch. Too low of inflation is bad because it basically postpones consumption. I'll give you the housing example. In 2009, when housing prices were still falling, why did nobody want to buy a house? Well, they all said the same thing. Well, it's going to be cheaper tomorrow. Why would I buy it today? I think it's going to keep falling. Well, that actual philosophy is what causes deflation. And even FDR had a quote on this, and he said, the only thing we have to fear is fear itself. And what he was basically saying is, go spend money. That's how you stabilize prices. Go spend money. And that's why deflation is a scare. It's a scare today in Europe. Europe's going through another deflation scare where prices are falling. So that's something to pay attention to, because if the Fed is forced to withdraw monetary support sooner than later, it can have bad effects both in the stock market and the bond market. So that's the thing that I think is the biggest risk right now. The last thing that we watch is indications for expansion, like acceleration of economic growth. Is the economy accelerating or decelerating? And you can't ask economists, because economists tell you what happened 3 months ago. They have no idea what's happening today because it's a big thing. So there are a number of different metrics or variables that you can look at. One of the ones that we pay attention to is something called the leading economic indicators. The leading economic indicators is a basket of metrics that are supposed to give you an idea of the direction and strength of economic growth, and it's pretty good. And right now, I can tell you that it has gotten better every month since April, but the rate of change is slowing. So it's getting better, but it's getting better at a decelerating rate, which tells us that, once again, the low-hanging fruit has already been picked. And 2021, it's going to probably be a little more challenging on the economic front than 2020, which is why you have all the talk of fiscal spending, because you are going to have this shortfall that has to be made up. And that's why the markets are rallying. The markets are rallying because with a single party in power in Washington, it means the ability to spend a lot of money is higher, and it means probably better support for the economy this year. Long term, however, you got to pay the piper, and it's going to cost you economic growth in the future. And it's a trade-off, and it's a trade-off that you have to decide that you want to make. Are we going to give up future growth to stabilize growth today? And it's in the form of higher taxes. It's in the form of lower productivity. It's all these things that are consequences of subsidizing today's growth by borrowing from future growth, and it shows up in low interest rates for the next, say, 20 years. So those are the three things that we watched through 2020, which improved, which is why the markets improved. And now in 2021, the improvements are probably going to be at a slower pace, and we should expect this. I'm gonna pause there, Stephanie, and ask you if that makes sense, if you want me to elaborate on any of those points.
I think that's really great, Nick. So just to recap, the three things, if just to make sense of all of the factors out there, are changes in the unemployment or employment rate, inflation, and then that basket of leading economic indicators.
Yeah,
Right.
those are, if you don't want to look at hundreds of data points because it makes me dizzy, those are three really good things to look at.
Well, I think it's nice to be able to pick a couple ports in a storm, given all that's coming at us right now. So with all that said, what do we think for 2021?
Yeah, there are a couple of things that I'll say outside of those economic data points. Other factors that investors should be mindful of is what's happening with the dollar. We don't talk about currencies very much because they're very, very confusing. Sometimes it's hard to think in terms of yens versus pounds versus euros versus dollars. But understand this, the dollar is going to rise and fall over time. And the rise and fall over time is going to be directly correlated uh, to buying and selling of dollars. Okay. When risk is apparent and people are looking to avoid risk, the dollar will typically strengthen in that environment. And when investors are scared, they go to the dollar, and the dollar will typically rally. Why? Because the dollar is the safe haven. When investors are looking to take risk, they're going to sell dollars and they're going to buy other things. And we saw this in the first quarter, the dollar shot up relative to all other currencies because you had a lot of money come into the US. However, now money is looking to do a lot of different things, and it's been flowing out of the dollar into the yen, into the euro, and recently into the pound, to the tune of, call it around 8%. The dollar's down 8%. So why does this matter? If you own foreign securities and you're a dollar-based investor, when the dollar comes down and you translate those returns from foreign currencies back to the dollar, it is an additional return component. So foreign markets made 8% more for US investors because the dollar came down. Now, in the last several years, it's been the other way around, where the dollar has strengthened and it has actually taken away from foreign returns. Now, currencies tend to be a mean reverting tool, meaning if the dollar goes down a lot, it's probably going to eventually go back up again because these things tend to counterbalance each other. If the yen goes up a lot, the yen's probably going to come back down again. In a lot of instances, the euro and the yen specifically are being managed. I hate to use the word manipulated because it sounds illegal, but they're being managed to be weak. The reason they want them to be weak is because if you have a strong dollar and a strong pound, it allows you to buy more foreign goods when their currencies are cheaper. And countries like Germany, France, Switzerland, Japan, China, and then a whole bunch of other